prices, inflation slowed for sure from the peak. But even before the tariff policies were implemented, there was a question about whether it would get down to the sort of central bank goal around 2%. And it looked like it was not. And these tariff efforts are, if anything, they're pushing inflation in the other direction. And so the idea that we're having inflation that's elevated relative to central bank targets seems pretty widespread. From the Fed's perspective, the Fed doesn't really care about it. Chairman Powell made it very clear in Jackson Hole that the only thing that matters to him is the labor market. And so, policy is basically being responsive to slower growth conditions, and even more than just higher unemployment, but actually slower outright growth conditions. And so they're easing into a period of elevated inflation, which and citing the inflation that is being seen as being transitory. And the last time we saw easing into elevated inflation, it didn't go so well for them. So maybe they forgot the lessons from just a few years ago.
Yeah, great point. Is sort of, but the Fed's incentivized not to act until late, and I guess the challenge then is that they're always in the wrong position, basically.
Yeah, well, I mean, they're certainly, I'd say, acting relatively aggressively in terms of their response to the labor market. Now, some people have argued that is reflective of political interference. Maybe there's certainly some folks on the committee that might be being influenced by the administration, but Chairman Powell is looking at the situation and saying that that they're a lot more confident that the labor market is weakening, that they're confident that inflation is likely to be persistent, given that it's being driven by the tariffs. And so you put that together, and so they're responding to the weaker labor market. So the reality is basically inflation can come in at any value and it has no impact on the Fed's behavior. The group that it does have an impact on is households who are getting squeezed, right? The Fed can choose to either care about inflation or not, but it's households have to pay the prices that are being seen, and that I think is, from a real economy perspective, is the biggest challenge, which is that households are seeing their income growth slow to something like 3 to 4%, with essentially zero job growth and 3 to 4% wage growth per worker. And prices have gone from, in the low twos back up to 3. It might be a little bit higher once tariffs flow through. And then you sort of add that up, and that's not a great situation where you have nominal spending power of 3 to 4%. And at the same time, you have prices rising at roughly 3% or a little bit higher. That leads over time to roughly a 0% real demand growth that is sustainable. And so that would be, that's a pretty undesirable economic circumstance in the United States.